Ladies and gentlemen, I want you to burn a number into your mind before we go any further. Not a forecast, not a fantasy, a closing price. $79. Just 2 days ago, this market was asleep. 48 hours ago, silver was trading in the low 70s while most of the world was carving turkey and pouring wine. And yet, while the headlines were quiet and the desks were empty, something extraordinary happened beneath the surface. On Christmas Day, I turned on this camera for one reason only. The data frightened me, not the chart you see on television, the liquidity data, the calendar, the structure of the market itself. I warned you about what professionals call ghost week, that dead zone between Christmas and New Year's when liquidity evaporates, when price discovery doesn't happen in pennies but in dollars. In that vacuum, markets don't walk, they lunge. And that is exactly what we witnessed. Silver didn't grind higher. It didn't politely rally. It detonated. One vertical session carried price from the low 70s straight through 75, 76, 77, and slammed into the high 79s. An $8 candle in a single trading day. Moves like that don't belong to calm markets. They belong to markets that have broken free from restraint. This is what a true blue sky breakout looks like. When an asset clears its all-time highs, resistance disappears. There are no trapped sellers, no overhead supply. Everyone is suddenly in profit. And when that happens, price doesn't climb stairs. It takes the elevator. Here's the part that should make you lean forward. Despite silver becoming the best-performing major asset on the planet, outperforming stocks, outperforming tech darlings, outperforming even crypto, the mainstream financial media barely whispered about it. That silence is not accidental. It is your edge. Because markets don't end in silence. They end in noise. And right now we are still in the stealth phase, but that phase is ending faster than most people realize. And tonight I need to show you why this move didn't start with retail traders and why what comes next is far more dangerous and far more profitable than anyone is prepared for. Now let's address the real question. Why did this move happen so violently and so fast? Ghost Week explains the conditions, but it does not explain the ignition. Low liquidity is gasoline. Something still had to strike the match. And what did was not emotion, not hype, and not retail speculation. It was mathematics. Early this morning, a signal flashed on institutional dashboards that most investors will never see. A signal so rare it has not appeared since the last great precious metals cycle. Pension funds, sovereign wealth funds, and university endowments do not trade stories. They trade ratios, they trade valuation dislocations. And today, the most important ratio in the metals market broke. The gold to silver ratio collapsed below 60. For years, that ratio lived at 80, sometimes 90. The message was clear: gold mattered, silver didn't. But when that ratio compresses under 60, the message flips instantly. It tells asset allocators that silver is historically undervalued relative to gold. Look at the numbers. Gold above $4,500, silver near $79. And to an institutional allocator, this isn't excitement, it's arbitrage. If you need exposure to hard assets in an inflationary, unstable world, silver offers dramatically more leverage per dollar than gold. This is why today's move wasn't retail FOMO. It was front-running. Traders who understand how institutional models work were positioning ahead of what comes next. Because when investment committees return from holiday, the models don't hesitate. They rebalance automatically. And here's the critical asymmetry. A few $100 million moving into gold barely registers. The same capital moving into silver overwhelms the market. Silver is thin. It doesn't absorb flows. It reacts explosively to them. That's why 79 doesn't feel like resistance. It feels like gravity. The market is already anticipating buyers who haven't even arrived yet. And when they do, the collision between institutional demand and a deeply short banking system will turn volatility into something far more dangerous. Now we have to talk about who is about to move this market, because the next leg won't be driven by retail excitement. It will be driven by institutions, the kind that manage trillions, and their timing is everything. These players don't react like traders. They move on schedules, committees, and mandates. They went on holiday with silver around the low 70s. They are coming back to a market pressing 80 with the gold to silver ratio already signaling rotate. When those desks power up, they won't ask whether the move is too fast. Their models will ask one question: is the portfolio misallocated relative to its rules. And that creates a different kind of urgency. In the institutional world, you don't get fired for being wrong in theory. You get fired for underperforming in practice. If silver is up massively and your fund has zero exposure, clients don't want explanations. They want results. That pressure forces late buying, and late buying in a thin market creates vertical price. Here's the danger: institutions are not price sensitive the way retail is. They don't wait patiently for the perfect dip. If an allocation model triggers, capital must be deployed. Even a small rotation out of gold and into silver can be meaningless for gold but catastrophic for silver because the silver market is tiny by comparison. That's why this next phase matters. Speculation pushed silver through old highs. Institutional accumulation can push it into a different regime entirely. And unlike speculators, institutions don't flip positions for quick gains. They lock them away. When silver gets absorbed into long-term vaults, it doesn't come back easily. So if you're staring at 80 like it's a ceiling, you're reading the chart the wrong way. This isn't exhaustion. This is the market pausing before a much larger force arrives. Now, we need to widen the lens, because if you think this story is centered in New York, you are already behind. The real price of silver is not being discovered in a single market anymore. It's being revealed through divergence. And the most important divergence right now is happening in the East. While Western traders fixate on 79, the physical market in Asia is trading at a completely different level. On the Shanghai Futures Exchange, silver has been pricing consistently higher, signaling something critical. Physical demand is outpacing paper supply. When one market trades at a persistent premium to another, it tells you arbitrage is broken. And when arbitrage breaks, it's never because of lack of opportunity. It's because of lack of metal. If the system were functioning normally, banks would buy silver in New York and sell it into Shanghai until the gap closed. That isn't happening. The spread remains. That tells us logistics are strained, vaults are thin, or the banks are unwilling to ship metal because they need it for themselves. None of those explanations are healthy. This is why every rally in the West feels like chasing a moving target. As New York steps higher, Asia steps higher first. The price you see on your screen is lagging the physical reality, and when physical markets lead, paper markets eventually have to catch up violently. This divergence matters deeply for institutions. When analysts run global pricing models, they don't just look at domestic futures. They look at where the metal is actually clearing. Seeing silver trade at a premium in Asia reframes the entire trade. It means Western prices are not expensive. They are discounted. That perception is dangerous for anyone short the market. It turns every dip into an opportunity and every smash attempt into free inventory for the strongest buyers. And this is how markets enter what professionals call a reflexive loop, where rising prices create more demand, not less. Silver isn't just breaking higher. It's being pulled higher by a physical market that paper contracts can no longer control. And this is the moment where price targets stop being technical and start being structural. This is where the narrative shifts from exciting to dangerous, because divergence like this doesn't resolve gently. It resolves through force. And the force building right now is coming from the collision between physical demand and a financial system that was never designed to deliver metal at this scale. While most traders were watching price spike, something far more important was happening quietly in the background. Futures holders were not taking profits. They were not rolling contracts forward. They were standing for delivery. In a market built on the assumption that almost nobody ever asks for the metal, that behavior is radioactive. December is supposed to be a quiet month, a transition period. Historically, deliveries are minimal because participants settle in cash and go on holiday. But this time, contract holders said no. They rejected paper settlement and demanded bars. That single decision exposes the fragility of the entire system. Futures markets operate on confidence, not inventory. They rely on the belief that paper claims will never be converted into physical demand all at once. When that belief breaks, leverage collapses. Every ounce that leaves a vault is an ounce that cannot be leased, rehypothecated, or sold 10 times over. It becomes sterile. This is why delivery data matters more than any indicator on a chart. Price can lie. Sentiment can lie. But metal leaving the vault cannot be faked. It tells you that someone with size, patience, and urgency no longer trusts promises. And here's the key insight. Rising prices did not reduce demand. They increased it. That tells you the market is nowhere near equilibrium. In a healthy system, higher prices ration demand. In a stressed system, higher prices validate fear. This is the point where volatility stops being random and starts being structural. The market is no longer negotiating price. It is negotiating availability, and when availability becomes the question, price becomes secondary. Now we need to confront the stress this physical demand is transmitting into the banking system, because this is where the story leaves the commodity space and enters systemic risk. When banks promise metal, they don't have. The problem isn't price volatility. The problem is liquidity, and liquidity is the lifeblood of the entire financial system. When delivery requests surge, banks are forced into a corner. They must either source metal at rising prices or post cash to cover their exposure. Both options drain balance sheets. This is not theoretical stress. It shows up immediately in funding markets. When banks scramble for short-term cash, they tap facilities that are supposed to be used only in emergencies. That's why funding spikes matter. They are the canary in the coal mine. When the cost of overnight money jumps, it tells you institutions are under pressure right now, not months from now. It means positions that were once considered manageable are becoming unstable at current prices. Here's the feedback loop few people understand. As banks are forced to raise cash to deal with delivery pressure, they sell other assets. That tightens liquidity elsewhere. Tight liquidity pushes central banks closer to intervention. And intervention, by definition, means currency creation. That currency creation doesn't solve the metal shortage, it amplifies it. More currency chasing the same finite supply pushes prices higher, which worsens the bank's short exposure, which forces more liquidity support. This is not a cycle, it's a trap. Markets sense this long before headlines catch up. That's why volatility accelerates instead of calming down. Every spike in price is interpreted as confirmation, not excess. Every dip is viewed as temporary relief, not resolution. This is the phase where policymakers lose control of outcomes and are left managing symptoms. They can smooth funding markets, but they cannot create metal. And when a financial system collides with a physical constraint, history tells us exactly who wins. At this point, it's critical to understand why this environment is so dangerous for traders using leverage, even if they are directionally correct. This is what professionals call the widowmaker zone, not because the trend is wrong, but because the volatility is designed to punish impatience. When markets transition from speculative participation to institutional accumulation, price behavior changes. Moves become faster, sharper, and less forgiving. You will see sudden drops that feel engineered because in many cases they are. Large players know exactly where leverage sits. They know where stops are clustered. And they know that forcing liquidations is the fastest way to acquire inventory. This creates a brutal paradox. The more bullish the long-term setup becomes, the more violent the short-term swings grow. That's how strong hands are separated from weak ones. A $10 drop in minutes can happen in a market that is fundamentally screaming higher. If you are over-leveraged, that single wick ends your participation. Physical holders experience this environment very differently. They don't watch every tick. They don't face margin calls. Volatility doesn't threaten their position, it validates it. That distinction is everything. This is why patience becomes a strategic weapon. Institutions can endure drawdowns because they are not trading for days or weeks. They are reallocating for cycles. When volatility spikes, they don't panic. They deploy capital. For the individual investor, survival matters more than timing perfection. You don't need to capture every dollar of upside. You need to stay in the game long enough for the thesis to play out. The tragedy of leverage in a breakout market is that you can be right on every macro input and still lose everything if you can't withstand the swings. This phase doesn't reward aggression. It rewards durability. Now we arrive at the point where evidence replaces theory. Everything we've discussed so far, institutional pressure, physical demand, banking, stress converges in one place, delivery data. This is the hard proof, and right now that proof is flashing red. In a normal December, silver deliveries are an afterthought. Contracts roll forward, positions are settled in cash. Volume fades into the background, but this time something unprecedented happened. Contract holders refused to roll. They refused cash. They demanded metal. The number of contracts standing for delivery surged to levels that simply do not belong in a holiday month. This isn't speculative behavior. Speculators don't want pallets, transport, and storage. They want price exposure. These delivery requests are coming from entities that need the metal itself, not the trade. This is where the structure breaks. Futures markets are built on fractional reserves. Multiple claims exist on the same ounce. Because historically, almost nobody demands it. When even a small percentage decides to convert paper into physical, the system strains. When that percentage grows, the system fails. Every bar that leaves a registered vault removes leverage from the market. It can no longer be promised to someone else. It can no longer be used as collateral. The paper pyramid begins to collapse from the bottom up. This is why delivery data supersedes technical indicators. It tells you the problem is not price discovery, it's supply discovery. And supply discovery doesn't happen smoothly. It happens through repricing. Markets can ignore charts. They cannot ignore empty vaults. And right now the vaults are sending a message that no amount of paper selling can silence. This is the moment where the story stops being about silver alone and starts being about the architecture of the entire financial system. Because when a small market like silver begins to stress banks' funding desks and collateral chains, it reveals something deeply uncomfortable. The system is far more fragile than it appears. Modern finance is built on leverage layered on leverage. Assets are pledged, rehypothecated, and reused as collateral across multiple markets. Silver is not just a commodity in that structure, it is a building block. When that block is removed from circulation through physical delivery, the leverage stack above it begins to wobble. This is why stress in silver spills into funding markets. When a bank cannot meet delivery obligations cheaply, it must raise cash. To raise cash, it sells other assets or borrows overnight. That pressure shows up immediately in short-term funding rates. What looks like a metal problem quickly becomes a balance sheet problem. And here's the critical insight. Central banks can provide liquidity, but liquidity is not supply. They can print currency, but they cannot print atoms. Every dollar injected to stabilize the system weakens the currency denominator that silver is priced in. That doesn't resolve the imbalance. It intensifies it. This creates a policy paradox. Allow prices to rise and banks bleed. Suppress prices with liquidity and currencies bleed. Either way, the nominal price of scarce assets must adjust upward. This is why markets stop responding to reassurance and start responding only to flows. When investors realize that the safety net itself accelerates the move they are trying to contain, confidence shifts rapidly. Capital moves from promises to possession, from paper claims to physical reality. This is how regime changes begin. Quietly at first, then all at once. And once trust shifts, it does not return easily. The market is no longer debating whether silver should be higher. It is pricing how broken the old assumptions have become. So now we arrive into the final question that actually matters. How do you survive and benefit from a market like this without becoming collateral damage? Because moments like these don't just create opportunity. They test discipline, psychology, and time horizon. First, understand this clearly. What you are witnessing is not a normal bull market. It is a transition, a shift from a paper-dominated pricing system to one increasingly governed by physical constraints. Those transitions are never smooth. They are volatile by design. They shake confidence. They punish leverage, and they reward patience. The biggest mistake people make in environments like this is confusing speed with risk. Yes, the price is moving fast, but speed does not equal fragility. In fact, when prices rise alongside rising physical demand, the foundation is stronger than it looks. Volatility is not the enemy here. Overexposure is. Second, zoom out. Daily candles are noise. Weekly structure is signal. As long as physical demand persists, as long as delivery pressure remains elevated, and as long as institutional models continue to flag silver as mispriced, the path of least resistance remains higher regardless of short-term chaos. Third, think strategically, not emotionally. This is not about predicting the exact top or catching every dollar. It's about positioning yourself on the right side of a structural shift. History shows that the largest gains in real assets don't come from trading them. They come from holding them through periods when confidence in paper systems erodes. And finally, remember this: wealth transfers don't announce themselves politely. They feel uncomfortable while they are happening. They look obvious only in hindsight. The people who benefit are rarely the loudest. They are the most prepared. If you followed this entire analysis, you are already ahead of the curve. Stay patient, stay disciplined, respect volatility, but don't fear it. The market is not breaking, it is revealing. If this helped you see the bigger picture, like the video, subscribe to the channel and share it with someone who still thinks this move came out of nowhere. And in the comments, type 1 if you're focused on the long-term signal, or 2 if you're still watching the noise.